I'm a self-made millionaire, and if I were starting over investing today from scratch, I would not be doing what 90% of the investors that you see online or know are doing. Because the world's biggest money managers like Vanguard, Fidelity, even the IMF, they are quietly warning that a major correction could be coming. And while most people are ignoring it, the rich are already moving their money. So in this video, I'm going to show you exactly what they're doing and why so that you can do it to get rich too. The first thing you need to understand is I don't invest on hype, I invest on data. And that's why I win no matter what the market is doing, because everyone can look like a genius on the way up, but on the way down, that's when people start to get exposed. Here's what the data actually says. The IMF, or International Monetary Fund, basically the world's financial watchdog, they are saying that markets are overvalued and a sharp correction could be coming because stock prices are running way ahead of company profits. The translation of that is people are overpaying for companies. And not only are they taking on too much risk, they are setting themselves up to make less money long term. High risk doesn't always equal high reward. Now, Fidelity, they found that almost all growth this year came from just a few tech giants. But then we have all these people who are new investors and they're going online and they're watching people talk about the hot stock to buy, and they are putting themselves in positions where they are overexposed. I have a girl who just started in my financial coaching program, and she came to me on the first day and said, "This is what I currently have in my portfolio. I have an S&P 500 index fund and I have QQQ." She said, "What do you think?" And I told her that the S&P 500 is heavily weighted towards tech right now and QQQ is tech. She thought she was balanced and diversified, but really she was just doubling up on the same companies like Amazon and Microsoft and Nvidia. This is what 90% of investors are doing right now. Okay, they are overexposing themselves to one sector. And what people don't understand is that the market moves in cycles. The types of companies, the sectors, the countries that do well, it's not always the same. So if tech struggles, they don't just lose money short term. They miss out on future growth because their money is not working across the whole economy. What's wild is that Vanguard now expects bonds, okay, the boring, steady stuff that nobody talks about, to perform just as well or even better than US stocks over the next decade. AKA, you can make more money, okay? What they're projecting for bonds, a 4 to 5% return per year, and for US stocks, it's only 2 to 4%. A stock is when you own a small piece in a company. You make money when they do well. A bond is when you loan your money to a company or to the government and they pay you interest. For years, stocks grew faster, but now bonds are actually paying again. And because stocks are so expensive, the rich are rebalancing. Now, in my portfolio, I'm not chasing fast growth because I'm living off of my investments. For the money that I'll need within the next 10 years, I have about an 80-20 split between stocks and bonds, and 20% of my total wealth is invested into income-producing assets like REITs and real estate and mortgage investment corporations, because those pay me even when the market dips. Check out my caption for more because I'm running out of time, but if you want to learn step by step how to buy your first stock and how to create a good portfolio that pays you, go to my link in bio.